Hello, everyone. Do you know how your taxes work for your investment accounts when it comes to capital gains, dividends, capital losses? I did a lot of digging, and based on my journey, I found some valuable content that I'm going to share today to help you out and help you navigate through all these confusing investment accounts in Canada. Full disclosure, I am not an accountant. In fact, I'm just some YouTuber who loves talking about stocks, real estate investing to help you grow your income, build your wealth, and ultimately live your best life. So in today's video, I want to go deep into the confusing environment when it comes to Canadian taxes and how does that impact you with your investment accounts. So if you want to optimize, be super tax efficient with your investment accounts, and you're just starting out in your journey or restarting in your stock investing journey, well, I'm going to be sharing a ton of valuable content in today's video. So when it comes to your registered retirement savings plan, which is essentially a savings plan for retirement, it's a great vehicle for people who are planning to make less money during retirement than right now. It's also a great vehicle if you plan to actually buy your first home because you can borrow money from your RSP tax-free and buy your first home, which is exactly what I did when I bought my first condo. This is also a great vehicle if you own, say, a lot of assets like real estate, like stocks that are in non-registered accounts, and you plan to sell them in the future. Then you can hoard up all your RSP room, and then when you say plan to sell those assets, you can dump a portion of those profits into your RSPs and help you offset taxes. So that's another way of using the RSPs and optimize your taxes. Now, who is it good for and who is it not good for? So when it comes to your RSPs, it's good for people who actually plan to make less income in the future when you're retired or when you're taking a career break than what you're making right now. So basically, it's a great vehicle if you plan to actually or control your income in your non-working years where you actually make less money than you're making right now. Because the thing about RSPs, when you draw money out of your RSPs and live off of, so let's give you a more specific example to just make it super tangible. If you are making $100,000 right now, and then you pull out $5,000 from your RSPs to live off of, then you're actually making $105,000. So you will get taxed like as if you're making $105,000. So any income you make in your RSP and you draw it out is treated as ordinary income. So this RSP account is not good for people who are actually going to make more money when you're retired than what you're making right now. The RSP vehicle is kind of like not a good vehicle for that reason. So when it comes to stocks, the best way to use the RSP vehicle is to buy, and if you love dividend paying stocks, buy US dividend paying stocks in your RSP, because if you buy US dividend paying stocks in any other account like your TFSA, your LIRA, your corporate account, your non-registered account, any other account other than your RSP, you will get taxed by 15% year over year, because there is a rule between a treaty between Canada and US where they say we're not going to withhold any taxes if you buy US dividend paying stocks in your RSP. That only applies to your RSP. Now, when it comes to your tax-free savings account, which is like awesome, like an awesome vehicle they're so lucky to have in Canada. So when it comes to stocks, your TFSA is an awesome vehicle for you to hold those stocks and have it grow tax-free. Now, the only time when it sucks is that if you hold US dividend paying stocks. So please don't hold your US dividend paying stocks in your TFSA because you're going to get slammed 15% year over year. The best way is to hold US growth stocks and Canadian dividend paying stocks in your TFSA. Oh, one more thing about the TFSA. If for whatever reason you grew your TFSA, say $200,000 in profit, what you could do is you can actually take out that $200,000 profit from your TFSA and you could contribute back $200,000 in the year after, meaning you are not limited by your contribution room. See, that whenever you make a lot of money in your TFSA, you're welcome to withdraw it tax-free and also be able to contribute that same amount that you withdrew in the next year, which makes it like amazing. So when it comes to your RESP, which is the Registered Education Savings Plan, which is essentially a savings plan, you can save for your kids, and the government contributes up to 20% to a maximum of $500 per year for every dollar you put in every single year. So basically they give you like free money every single year. Now, the great news is that you can use this RESP to buy stocks, or buy GICs or whatever you want to grow your money even further. So when it comes to stocks, you can pretty much buy any stock except for, and this is what I'm advising, is to not buy US dividend paying stocks, because unfortunately if you buy US dividend paying stocks, the government unfortunately withholds 15% every single year, because that's the way it works in Canada. So if you own money, if you have money in your RESPs, buy Canadian dividend paying stocks, buy US growth stocks. Just avoid US dividend paying stocks. One more thing about the RESPs. When your child decides to withdraw that money from your RESPs, it gets treated as ordinary income. So what that essentially means is that, say in the future, one of your kids decide to take out like $15,000 of RESP money to pay for school, well, that $15,000 gets treated as like regular income, like as if they made $15,000 that year. But of course, there's lots of write-offs while they're in school, like tuition tax credits. That's basically going to make it like essentially tax-free. So the downside to this method, to this strategy, is if your child decides to work in a big like corporate job during the summer and make a ton of moolah, then maybe you might want to rethink this strategy. But I think most kids are not going to be like making a ton of moolah when they're in school, so you're probably okay saving a ton of money in your SP for your kids. Okay, when it comes to your non-registered accounts, this gets super complicated. This includes your business account. So if you're a small business owner or your business owner where you actually retain profits in your business account, like in your corporate account, and you want to do something with it, which is like invest in it, then this is going to really apply to you. See, in Canada, we have 3 ways of taxation when it comes to non-registered accounts. The first way is interest income. The second way is capital gains. The third way is dividend income. Okay, those 3 different sources of income gets taxed differently. The number one way to optimize your taxes, or essentially pay less taxes, is to first maximize your dividend tax credit. So basically, please buy Canadian dividend paying stocks, because we are so lucky in Canada where we have the dividend tax credit only if you buy Canadian dividend paying stocks. So essentially, you can get up to $50,000 tax free. So if you collect, say, $50,000 of dividends from Canadian paid companies every single year, you could potentially get this tax free. The only caveat is that you can't have any other sources of income during that year. Otherwise, it kind of just gets a little bit tricky, and you have to talk to your accountant about how to balance that out. But essentially, the number one method, if you have non-registered accounts, is to buy Canadian dividend paying stocks, because you can pretty much collect it tax free. Now, the second best strategy for your non-registered accounts is to buy growth stocks, because in Canada we're so lucky to have where if you buy growth stocks, well, as long as you don't sell them, they don't get taxed. But once you sell them, the most amount of taxes you will pay is capital gains tax rate. In Canada, the capital gains tax rate is probably like maximum around 25% plus or minus a few percent here or there, because how it works is that if you made, like, for example, $100,000 in profit from, say, your Tesla stock, and you sold it in your non-registered account, well, that $100,000, only 50% of that is taxed. So only 50%, like $50,000, is taxed at your taxation rate. So basically, just think of that $50,000 is added to your income, and then that's what you get taxed on, not the whole $100,000. So essentially, that makes it super, super efficient when it comes to taxation. But of course, again, I'm not your accountant, so please double check your account before doing that. So the worst way to invest your non-registered investment accounts is actually to buy like guaranteed investment certificates, or basically hold it into a high interest savings account, because interest income is treated like job income, or worse. Please do not buy REITs, which are real estate investment trusts. See, the thing with REITs, they're a complicated beast. Like, if you own RioCan or Smart Centers, see, I know it gets super confusing because these are Canadian companies that pay like a distribution every single month, but those are not called dividends. They are not considered Canadian dividend paying stocks. They are they're purposely called distributions because these distributions have 3 different tax rates. You get taxed at a capital gain tax rate, you get taxed at the interest income tax rate, and you get taxed at the dividend tax rate, which makes these a super complicated beast. So please just avoid REITs when it comes to your non-registered investment accounts. And of course, bonds and guaranteed investment certificates and high interest savings account, because those get treated as ordinary job income. So when it comes to capital losses, this is when, say, for example, you bought a stock and it lost a ton of money because you bought a stock like Hertz. Okay, so when that happens, unfortunately, if you bought Hertz in your TFSA or in your RSP, you can't write that off because Canada does not allow that. But if you bought Hertz, say, in a non-registered account, then you can write off that tax loss. And you could back calculate this by 3 years, and carry it forward to as many years as you want. But the thing about capital loss is that you can't write off all those losses. Unfortunately, just like the capital gains tax rate, you can only write off 50% of the losses against your income. Hey everyone, I hope you found this video super, super helpful. If so, please smash that like button, hit it, so you let me know that you like this video. Anyways, if you haven't subscribed, why not? I talk about stocks and real estate investing to help you grow your income, build your wealth, and ultimately live your best life. So please hit the subscribe button and that bell notification button. I'll see you next time. Thanks for watching.